Thanks for joining us at lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get you the headlines. Nifty and Sensex fall for a second day, dragged by Yes Bank and Tata Motors, but the benchmarks are off the day's lows.
SEBI board will consider a whole host of issues, including tighter norms for rating agencies and mutual funds.
Minutes of the FOMC meeting in the US and the RBI's Monetary Policy Committee meeting minutes are also due today.
P. Chidambaram's plea for anticipatory bail is referred to the Chief Justice of India. The former finance minister is yet to meet CBI officials, waiting for him outside his residence.
All right, let's first take a look at how markets are faring. Yatin is here with us. Afternoon.
Afternoon, Neera, and of course the markets are down by about 0.3%. However, if you look at the mid-cap and the small-cap indices, they are down almost 1.5% each. So the pressure really is on the broader markets. Tata Motors, the entire auto pack is moving. In fact, if you look at Hero MotoCorp, Eicher Motors as well as Maruti, all of these stocks are the top gainers on the Nifty at this point in time, 1% up for each of them. Infosys and HUL are other stocks which are doing well in trade today. In fact, the market is led largely by auto as well as FMCG names. Tata Motors, as I was mentioning earlier, that stock is down 6.5%. No particular reason for the fall today. But in general, there have been talks of rating downgrades, which have been further putting pressure on their unit Jaguar Land Rover. Yes Bank, Tata Steel, as well as Infratel are the other stocks which are down anywhere between 2.5% to 4.5%. In terms of active securities, watch out for Indiabulls Housing Finance. Fresh shorts are seen in the future and option segment. That stock is down 3%. Along with that, Tata Motors as well as Yes Bank are looking at some fresh shorts which are getting created. 5% down for each of them, as I was mentioning earlier. If you look at ITC, that is also one interesting name, which is one of the top traded counters by volume in trade today. That stock is also low by about 1.5%, underperforming the FMCG index today.
Nathan, thank you for that. SEBI, meanwhile, may tighten its norms for rating agencies and also mandate that mutual funds reduce their exposure to risky assets. The regulator's board will be meeting the afternoon today. Sajid is here to take us through what's on the agenda.
That's right. The regulator is meeting today, and it's expected to bring in some tighter norms for credit rating agencies, especially with respect to disclosures of delayed payments and defaults on loans taken by companies. So far, that was the responsibility of CRAs. Now, SEBI may, arm the credit rating agencies by asking the companies or issuers to ensure that they disclose the no default status report to the credit rating agency on a periodic basis, and that would bring in more transparency as far as reporting of those ratings of those instruments. On the other hand, the SEBI is also looking to bringing little tighter norms with respect to exposure to unrated debt instruments and mutual funds. They may bring it down from 25% to 5% in a phased manner. Again, that's a board which is going to take a call on it, and some relaxation that may come in from the buyback on a buyback front, especially with respect to what we saw in the case of L&T, when the company L&T's debt to equity was more than 2:1, because the regulations currently include subsidiaries or financial services companies debt also as part of calculation of debt equity ratio. Now they may segregate it into a standalone and may allow for buyback for those companies which have financial subsidiaries, subject to the fact that the subsidiaries debt equity is within 5:1.
Sajid, thanks so much for that. HCL Technologies is the cheapest Indian technology stock right now, despite the company projecting the highest revenue growth for the current financial year. So does the market think that it is ripe for a re-rating? Agam Vakil has the answer. Agam.
Well, right, Ira, HCL Technologies is not only the cheapest stock in the Nifty 50, but also among the many of the mid caps. In fact, all companies, all information technology companies with a market capitalization of over 5,000 crores. And as you can see out there, Tech Mahindra and HCL Technologies tied at 14 times FY20 price to earnings ratio. So let's take a look at why this may be a case for a re-rating and case of undervaluation for HCL Technologies. First of all, when it comes to the growth outlook, the company has was suggested, and the revenues growth of around 14 to 16% and guided for actually for FY20. This is against double-digit growth for TCS, which comes to somewhere around little over 10%. Infosys recently upped this guidance as well, but the upper end of that range is 9.5%. Wipro and Tech Mahindra looking at anywhere between 3 to 7% as per analyst expectations, which actually sets HCL Technologies right at the top in terms of growth. Moving on, let's also talk about the other factors that come into play here. Now, of course, we must remember that there are 2 times that HCL Technologies was trading at significantly higher valuations, but they came off. Once was last year when it bought the IBM products, and the second time was just a few months ago back in April, where we actually saw contraction profitability. Now, moving forward, however, analysts are very constructive on the stock, and they certainly do feel that there is an upside as far as HCL Tech is concerned, considering 35 or nearly 73% of analysts tracked by Bloomberg have a buy rating on the company. They're also putting a price target of around nearly 1,200 rupees per share, which means at least 10% upside from current market levels. That said, there also are there's a lot of commentary that's coming out from your brokerages. So you have the likes of CLSA as well as Edelweiss. They're suggesting that HCL Tech is poised for industry-leading organic growth. That's growth beyond just the acquisitions it has made over the last year. Its core momentum is intact. That's what HSBC is saying. Phillip Capital, of course, is one of the few which is still skeptical of organic growth when it comes to HCL Tech. That said, there are still a lot of concerns when it comes to their margins. Now, we know that the margins are contracted 190 basis points in the first quarter. Why? One is because of the integration of IBM products. Secondly, of course, the strong rupee, higher visa costs. And let's not forget, the company has not yet undertaken a wage hike, which will come into play in the second quarter. But despite that, despite all these factors, the company has actually maintained their margins guidance as well, which is 18.5 to 19.5%. And that gives a lot of confidence to a lot of these analysts who are suggesting that as we see the deal pipeline come through, in terms of revenues, we will see an eventual improvement in margins as well, and that should not be too much of a problem. And that's the case they are putting forward for HCL Tech to re-rate from current market levels.
Agam, thanks. A global glut in natural gas is threatening the viability of a $4 billion project commissioned by Reliance Industries. The Petcoke gasifier at its Jamnagar complex may not yield as much returns as previously projected. Debjit Chakraborty of Bloomberg News joins us to explain why and the reasons behind it. Debjit.
That's right, Harsha. This Petcoke gasifiers project, which entails an investment of $4 billion, which Reliance had planned in 2012 to cut down on costly LNG imports to be used as fuel, has kind of got delayed. It was supposed to get commissioned in 2016, but they finally got commissioned only. All the 10 gasifiers got commissioned only last quarter. So that means that the advantage they were supposed to bring in for Reliance, the advantage in the sense that they were supposed to uplift GRMs by $2 per barrel, has not materialized because from the time of the conception of the project and now the prices of LNG have crashed from $15 to less than $5 now. So that means Reliance is continuing to import lots of LNG and are not able to run the gasifiers at optimum capacity because LNG seems to be more economical than the turning the petcoke, bottom of the barrel petcoke, into syngas to be used at the refinery complex. So this means that the crash in the gas prices kind of undermines the investment, the huge investment Mukesh Ambani had committed to change the fuel need, the source of the fuel need for the Jamnagar complex.
Debjit, thank you so much for joining us with those details. P. Chidambaram's plea for an urgent hearing has now been referred to the Chief Justice of India. The former Finance and Home Minister has challenged the High Court's decision to deny him anticipatory bail in the INX media case. Meanwhile, the CBI has also started making rounds to his residence, but are said to have been unable to meet Mr. Chidambaram yet. Upmanyu Trivedi of Bloomberg News now joins us for more details on this one. Upmanyu, where is this headed?
Yeah, as you said, CBI has been trying to meet Mr. Chidambaram, and they've also summoned him for questioning. Apparently, within 2 hours, he has to appear to CBI as soon as he receives the notices. We understand from our sources that Mr. Chidambaram's lawyer has responded to that notice, asking under what law has the CBI sought his presence under just 2 hours. Meanwhile, as we know, his anticipatory bail was denied yesterday by the High Court, which made some strong observations, saying he was the kingpin and the key conspirator in the case that relates to alleged illegal foreign direct investment into firms led by his son. So his lawyers, which include Kapil Sibal and Salman Khurshid and others, they've been trying to get an urgent hearing in the Supreme Court as early as possible. They tried earlier today, this morning, when Justice Ramana's bench said that the matter will be placed before Chief Justice, and the Chief Justice will take a call on when the case will be listed. Now, the Chief Justice's bench has been busy in the 5-judge Constitution bench, which is listening the Ayodhya matter. The lawyers of Chidambaram were hoping to meet Chief Justice at 1 p.m. But now we are told that the Chief Justice is likely to take a call on whether to list it urgently or not at 2 p.m. So we are eagerly waiting for as the hearing happens, where lawyers have argued that Chidambaram is a parliament member and a practicing advocate, and there's no chance of him fleeing. But the CBI and Enforcement Directorate is arguing that that it's a serious case of a huge magnitude, where his custodial interrogation is required because he has not been cooperating in the case.
Upani, thank you so much for that. Meanwhile, senior Congress leaders Salman Khurshid and Abhishek Manu Singhvi, this is what they had to say about Mr. Chidambaram's anticipatory bail plea by the Delhi High Court.
Regretful, very regretful. We've said so. I think the whole episode is very sad. It's very, very sad. Nobody's running away. The law will take its course. Nobody's running away, but you have to have some. What else will it? What else is it? But let's see what the court does.
मैं मानता हूं कि तथ्य बड़े सर्वविदित हैं. हम मेरिट्स की बात नहीं कर रहे हैं. वो अभियुक्त अक्यूज्ड है, वो कन्विक्ट नहीं है, ट्रायल नहीं हुई है. 15 महीने से जो व्यक्ति बेल पे हो, 7 महीने कल वाले ऑर्डर को देने में लगे, रिजर्व रहा 7 महीने के लिए. एक बार, लोगों को पता नहीं है ये बात, एक बार सीबीआई ने बुलाया उनको 6 जून 18 को, वो आराम से गए. उसके बाद कभी बुलाया नहीं. ईडी ने 8-9 बार बुलाया, हर बार गए. तो जिसको हम कहते हैं कि 3 मुद्दे या कसौटियाँ होती हैं बेल के विषय में. फ्लाइट रिस्क, आप भगोड़े हो जाओ, वो अराइज नहीं करता माननीय चिदम्बरम जी के लिए. उनके रूट्स हैं यहाँ पर, उन्होंने कभी बाहर जाने की अर्जी नहीं दी, उनका पासपोर्ट रखा जा सकता है. दूसरा होता है टेम्परिंग. 2007-8 का मामला है. सब दस्तावेज उस वक्त के हैं, फ्रीज़ हो गए हैं. टेम्परिंग का संभावना ही नहीं है. जो साक्ष्य हैं उनके स्टेटमेंट्स रिकॉर्ड हो गए हैं. टेम्परिंग का संभावना नहीं है. तीसरा है नॉन कोऑपरेशन, असहयोग. असहयोग का सवाल कहाँ उठता है? जब बुलाया तब गए वो. तो इसलिए मैं समझता हूँ कि ये परसिक्यूशन है या प्रोसिक्यूशन है, ये देखना पड़ेगा.
All right, let's go in to the money markets as well. We've got a whole lot of news likely from the central banks. As we had pointed out, the RBI will put out their minutes for the last MPC meeting. The Fed minutes are also awaited. And of course, we're all moving towards the Jackson Hole Symposium as well. Hopes are running high that the US Federal Reserve Chairman Jerome Powell will kick off the Jackson Hole Symposium later this week with a speech that signals his revving up for further rate cuts. Kathleen Hayes of Bloomberg News tells us why Powell may disappoint.
Traditionally, at this Kansas City Federal Reserve Symposium, going on more than 30 years now, people from all over the world gather at the Jackson Lake Lodge in Jackson Hole, Wyoming. Jay Powell, of course, last year gave a speech. He kicked it off as the Fed chair does every year. In fact, that's him last year on the right with Esther George, president of the Kansas City Fed, and John Williams, New York Fed president, in the middle. What people expect to see now is, come on, Chair Powell, you've got to give us a signal of what the world seems to be waiting for, that this isn't just one rate cut. It isn't just something to adjust things temporarily and see what happens. You can see the distress around the world, and you're ready to do something on rates. Now, to talk about distress and why that view might be justified, jump into the Bloomberg Library with me now. Got a really good one. It is the New York Fed's probability of recession in the year ahead, and they're looking at Treasury spreads and actually more elements. It's above 30. It's at 32. Whenever the recession odds are over 30%, they've been followed by a recession. This has happened since 1967. That's a long time. So let's move to the next chart now. And that is what the markets are pricing in terms of rate cuts. Now, we've had that one on July 31st, the first 25 basis point rate cut in 10 years, of any size rate cut in 10 years. Now what you see here, okay, this is where the Fed funds rate is, about 2.1%. That's where it's targeted. This is where it is expected to go. That's 60 basis points lower. That's more than 2 rate cuts. Now, they wouldn't cut 60 basis points, but traders are saying we expect 2, if not 3, by the end of the year. Yield curves have been flat to inverted. 30-year bond yield went below 2% for the first time ever, and more negative bond yields. 16 trillion total now. A lot of people say, look, we're trying to tell you something. The world has slowed down. Inflation is low. Global central banks are going to be cutting rates more. It's time for the Fed to get in step and adjust with more rate cuts.
All right, back home, there are more and continued calls for a fiscal stimulus to jumpstart the economy. The Q1 GDP data, which is expected at the end of the month, is expected to show growth remain below 6%. But there's much confusion, firstly, about where the slowdown is stemming from and then what we can do about it. Joining us to talk about some of that is Rajiv Malik, founder and director at Macro Shanti. He's joining us from Singapore. Rajiv, good afternoon. Thanks so much for taking the time to speak to us here at Bloomberg Quint. Much confusion in the narratives and the solutions, etc. So let me first ask you about what you make of what you have seen from the incoming data, not just the last round of GDP numbers, but since then the high-frequency data and the commentary from the RBI and the MPC. What's your understanding of the state of the economy right now?
It's really the most surprising thing to me is how surprised people seem to be about the unfolding slowdown. The seeds of this and the signs of it were apparent even around the beginning of the year. And if you think about the budget that was just a short time ago, there was really no hint in that the state of the economy would warrant some kind of a stimulus package, because the budget certainly didn't talk about it. So I find it quite perplexing in a way as to how quickly people have shifted a narrative from talking about how non-agriculture growth was strong and core inflation is high and therefore the central bank should not, MPC should not cut rates, to now completely going the other way. The fact of the matter is India had started to slow down even as global growth was holding up well, and now that it's going the other way, we will see a more pronounced impact of that. To a large extent, India's growth was predominantly a one-trick pony, relying on private consumption, which had been held up in large part by debt financing. And post the NBFC crisis late last year, a lot of that unraveling has taken place. So, after 3-4 years of strong private consumption growth, there's a natural tendency for momentum to slow down. We were beginning to see some signs of that, and then it got whacked by the whole NBFC fiasco, and that further slowed things down. And that is getting overlapped with now a global growth dynamics, which is going to play out even much worse. So, the future is always bright in India, and next year's growth will always be far better than this year's growth. But my sense, and I think I mentioned here several months back as well, there is no reason to think that growth is going to turn around anytime soon. We could clearly be down in the dumps for longer, simply because, my main assessment for India remains it's like a truck with a messed up gearbox. You can change the tires, you can paint it, you can do many wonderful things, but till you get the gearbox going, and that to a large extent is the financial system, you're not really going to see any meaningful revival, let alone as far as investment cycle itself is concerned. So to a large extent, the slowdown has domestic drivers. It is going to get complemented by external parameters as well now. It is both cyclical and structural in nature. RBI governor may not think so about the structural angle, but all you have to ask yourself or ask any analyst is whether her expectation about trend growth in India have come down. And that clearly will tell you a structural dimension is at play.
Sure. Rajiv, I have two questions. One is there a case for a stimulus? And, should there be a stimulus at this juncture? And if that be the case, what are the options?
So, any kind of a slowdown analytically has three policy options to be dealt with. One is, of course, your fiscal side, fiscal stimulus package. The other is on monetary easing side. And the third, somewhat related to the second one, is exchange rate depreciation. India has not really aggressively followed the third option, so let's keep that aside for a moment. We've seen the rupee depreciate. A lot of it has to do with global dynamics. And I don't think there's going to be any concerted effort to weaken the rupee substantially, because that then unfolds its own Pandora's box, opens up its own Pandora's box in terms of investors, especially on the debt side, becoming a lot more scared and staying away. That leaves us fiscal and monetary. We've already seen monetary easing come through. My view remains that the MPC has been slow off the mark and has moved gingerly. It could clearly have been more aggressive, and even now it can be more aggressive given the headroom comfort it has on the inflation front. But in India, the focus is always on the fiscal side, because bad news can also mean big business. And at the same time, the issue is a plain vanilla stimulus by itself is not really going to do much. It should be complemented with some long overdue reforms, be it on the factor markets, be it on the financial sector side. These are tangible issues that will only make any kind of a stimulus more effective. My sense remains, and as is typically the case, especially in India, but also in other markets, investors and financial markets are always betting on a bigger, more aggressive stimulus than what is going to come about. My own sense of this government is that it's not really losing its head about the speed or the nature of slowdown. And as typically happens, the child that cries the loudest will get most milk. In India's case, the sector that's making most noise about the slowdown and its implications, especially politically sensitive job creation, will probably land up getting some goodies. But it is going to be targeted predominantly on sector-specific private consumption side, maybe a bit on infrastructure, because that's always an evergreen area. But that's pretty much about it. I would not be too hopeful of a very aggressive, a big package that comes and does everything. I don't think that's on the table.
Rajiv, just going back to, some people say it's a theoretical debate about the nature of the slowdown, although I don't think it is. On the structural side, is it largely the financial sector that worries you? There have been some analysts who have pointed to the fact that the savings rate has been sort of slightly declining, and consumption as a percentage of GDP has been going up, like you said, sort of probably debt fueled. Is that also an issue? Because if it is, then the manner in which to tackle that is a whole different ball game.
It is, and again, bear in mind, India is still very much an evolving story, right? I mean, our household indebtedness is really not as high or as worrisome as some of the peers might necessarily experience. But it is fair to say that when you have a combination of savings rates going down and private consumption actually holding up quite well, and clearly debt has been the intermediary there, that actually can't continue forever. And clearly something has to give. Now, is that a structural or a cyclical slowdown? Well, if you think that debt financing can continue forever and ever, obviously there is nothing wrong with it, but that is not really the case. It's also interesting that once again, India is showing that it is difficult to maintain its high growth phase. We've been through these cycles, different cross currents, different pressure points, but sustaining growth at a high level in India's case has always been challenging, and once again that is coming about to be the case. My sense is, I think both the etiology of the slowdown and what needs to be done, both are a bit in a limbo. And part of it is, I think, for the last several months, we have selectively tried to ignore some of the signs that were indicating that, look, a slowdown is imminent. And at the same time, the MPC, I mean, if you look at MPC's growth forecast over the last several sessions, it is absolutely amazing. It's been cutting its growth forecast by a minuscule 0.1 percentage point every 2 months. That's not even a rounding error for any analyst. And, you know, so at a time when they clearly had the option of stepping up and trying to come up with a more aggressive interest rate response, fully well knowing that the transmission has been weak, that to me actually argues for a more aggressive option, not a more timid option, as has been the case.
If the government were to sort of respond with sector-specific measures, as you are indicating, you know, it really doesn't have the fiscal headroom, does it, to go and spend? Where's that money going to come from, you think?
So that's where you get into the next step, right? I mean, as I often say, policy making is about solving a problem without creating another one. And as you rightly pointed out, there's not much fiscal headroom, which is precisely why it is not going to be a big package, so to speak. There's a natural slowdown unfolding. Don't also forget that this government has relied much more on microeconomic delivery rather than macroeconomic growth. And I think the election result itself showed that quite effectively. So I think a slowdown, unless it is very pronounced and has a catastrophic impact as far as job creation is concerned, you're not going to see a big, aggressive, be-all and end-all kind of a package. Auto sector will clearly be one beneficiary that will come through. Whether that happens directly as to what is given to the sector or in terms of some cuts in taxes that make cars cheaper to borrow, which essentially means you're borrowing growth from the future. So at some point that is going to run its course as well. Like I said, I don't expect a big package, partly because the fiscal concerns are still very much there. Even if you go by the official numbers, if you actually take a more realistic picture, the actual fiscal picture in India is far more expansionary what the official numbers would be suggesting. So to me, between the fiscal side and the monetary side, I would actually say there is more scope still on the monetary side, as long as the MPC does not move in a very gingerly manner as it has been doing. But ultimately, as happens in India all the time, it's going to be a little bit of everything. So a little bit of fiscal, a little bit of monetary side will come together to try and carry the burden.
So you do think there's still more space, Rajiv, on the monetary side? So we're down at 540 on the repo. What would be, how would you judge the room? Let me ask you that way. Well, which is where I think MPC in its recent meetings has only created a lot more confusion or uncertainty in a way, right? I mean, earlier on at least we had some kind of a hand-holding guide in terms of real interest rate that has been completely thrown out of the window because nobody talks about it anymore. But at the back of their mind, there would be still some kind of a benchmark. And I would think a repo rate going down to 5% is not outlandish at all. Now, the question is, should they move aggressively and do it, as a one-step bullet, 40 basis points, or they do it in, 15 and then 25? I mean, those are really silly combinations that we are dealing with now. No other country does that, and I don't want to bring up China and Taiwan again, which is what everyone who's trying to apologize for this 35 basis points tries to do. They have not followed India's pattern, and they certainly are not the benchmark or the yardstick for monetary frameworks. So I think there's another 40 basis points to come through on the repo rate, at least. Whether it's done in one time or two steps is anybody's guess. Rajiv, one last question, this one on the liquidity and sort of the credit market environment. So, now liquidity is on days 2 lakh crore in surplus. But it's done precious little. Even if you look at the AAA bonds on the corporate side, you have hardly seen any reduction in the spreads. In fact, the spreads have widened because the market is not willing to let these bonds trade beyond a certain point of a yield. So the market is just, it's not frozen, but it's not willing to transmit this. So forget about the lax transmission on the banking side. This time even the financial markets are not really transmitting easier policy.
Well, that's right, and there's a good reason for it, because partly the worry is purely on the fiscal front. And the question really is what happens to the kind of premiums one would have to deal with. So we've seen an aggressive move in risk-free rates coming down. But clearly now with more talk about fiscal side and how worried or desperate the government is going to be in its response, because it seems to have been somewhat caught off guard. Otherwise we would have seen some constructive action in the budget itself. So even if it is at the margin, they will have to do something. And as you rightly point out, that is what is contributing once again to the transmission not being effective. So the solution is very much with the government to try and deal with that. I should point out that once again, while the stimulus package can be there, it is not as if the government does not have options to try and limit the slippage. Privatization is always there, and everyone will come back and say, look, it's politically sensitive, but look, something has to be adjusted. Equally, there's a whole host of assets that can be monetized, land banks, etc. Maybe it requires a bit more thought process to go through those kinds of things. But a lot of that monetization can actually take place, and now is the time to do it. The typical pushback on privatization or selling stakes is, are you going to get the best price? And again, a lot of times it is not about getting the best price, but whatever is the right price at that point in time. And there's a big difference between the two.
Okay, Rajiv, I'm going to end with the last question, which is slightly intangible, but to me it remains an important one. And you're viewing this from the outside. Do you see enough sort of thought leadership either within the government or within the central bank to be able to pick all these parts apart and say that this is the right mix of solutions? It seems both at the government level and at the MPC level, we're not getting a coherent either sort of solution or an understanding of the problem.
Well, I would agree with you. I think there is a missing link, or rather there are several missing links. Investors don't need to be taught about vocabulary or tough words, as Governor Das tried to do a couple of days back. They're looking for clean, simple assessment and what potential options can come about. And we are well past that situation where everyone had a rah-rah approach about a fastest growing economy. I think there are very relevant, tangible, important issues that need to be dealt with, and just a plain vanilla fiscal package is not going to do it. It'll have to be complemented with both monetary side and with underlying structural reforms. But because there is not much talk about it, there's hardly any talk, and just trying to reassure investors day in and day out with the same placebos begins to lose its significance. So I think there has to be some thought leadership that has to step up, whether it is from MOF or from RBI, to try and give investors a sense that policymakers know exactly what's happening.
Rajiv, we'll leave it there. Many thanks indeed for joining us with your perspectives. Rajiv Malik from Microshanti. Out of time on the show. Thank you so much for joining us today.